back 21 years ago when I got started, I saw my partners entering board meetings and sharing all their advices with the entrepreneurs. And entrepreneurs would say, great, yes, wow, you are so smart and full of wisdom. But when it was my turn to give advice, I think they said, yes, you're so great. But the next board meeting, they did not act upon whatever I told them, right? I think entrepreneurs must see a lot of these VCs, that some you respect and some you don't, to be honest. Some you only respect because they bring money to the table. I would like the fellow panelists to think about and reflect on themselves, their experiences. Who do you think the entrepreneur should partner with? The ones with experience or the ones that have money but decided to stand on the sideline just to let you play your role? And if we could start with Randy.
Yeah. I love the whole ecosystem of the startup infrastructure. My wife and I have made 55 investments at Keiretsu, and one of the great criterions to, to drill down to your question is, do I respect the entrepreneur? Will he listen or she listen to what and we want to give resources. It's not advice. I mean, we're not going to fund a company if they don't get it. And so if they receive the resource and do something with it that I want to invest. Now, personally, when I invest milestones. So let's say I have a $500,000 commitment. I will only give $100,000, and if they don't get those resources and grab the resources that we're providing, and we're fortunately have 3,600 members around the world, and we encourage our companies to obviously, garner those resources. So, number one, I have to really enjoy the CEO, obviously man or woman. And I really want to, see if they receive the knowledge and receive the resources. We had, was anybody in the room at our large event in San Francisco last week? I had a CEO of Safari, which we rang the bell 4 months ago, and he took all the resources. A $400 million company today, and he came to us at pre was under 10 million, but we gave him tons of resources. It's a company solving MRSA issues, young kids with cystic fibrosis around the world. And he took those resources, now he's a public company. And so, if they're receptive to the resources, then I'll do business with them.
Sounds good. Because you're senior enough, you think your advice is actually worth something to them.
I don't think my advice is worth something. I think my contacts are worth something.
Great. I just want us to be also cognitive. We have 50 minutes for our panel. We have 6 people. Yeah, thanks.
I think when I think about board activity and working on my boards, I don't think of it as so much advice. I think of it as work, right? So I have one board now that has 6 executives, and I personally recruited 4 of the 6 executives. So when I was first starting out, Andy Ratcliffe was my venture capitalist, and he described it to me as recruiting is your #1 priority to a young entrepreneur. Once they get the money, they need help, they got to scale, and then they have to have really strong people around them. I experienced that with Reed Hastings. That's what Andy did on that board, and then I've tried to emulate that in terms of other places. Second part, quick answer to that is about 7 years ago I made a movie called Something Venture. It's about the origins of the Silicon Valley and about how Apple got funded and Intel got funded. And one of the things I felt like I learned from those kind of legendary venture capitalists, the Arthur Rock and Don Valentines of the world, is that you have to adjust and work with a lot of different kinds of entrepreneurs, right? Cisco became one of Don's biggest hits, and obviously he fired the founder and had a big row associated with that. So you just have to be kind of prepared. You don't know what you're gonna get when you get started on a board, and you have to be nimble and prepared to do whatever it takes to try to make the company successful. Sometimes that means taking the CEO aside and putting in somebody else, and sometimes it's just simply supporting the CEO until the end.
Great. Yeah, perfect, timing to segue, from my personal experiences, and also Paul just mentioned them. During my days raising money, it's very common in such a setup, the VC come in and, some VC say, yeah, usually many times the founder become growing like a bottleneck. Very much true in Cisco's case. The couple were later on maybe resign or let go, and you have today's when I joined Cisco 1995 was every 6 months stock double, and then you split, then you double. It's just amazing. Without the funding team in the company, that's become possible. but quickly coming to today, from our days to be an investor in the last 9 years, things changed so much. You heard about entrepreneur-friendly theme, right? So the VC coming to help you. The thesis is the way to helping a founder with vision, to helping to equip with the management skills. It is much easier task than have a professional MBA coming to the CEO and force him to learn product vision, company vision. It's very different difficulty levels. That's why you heard about in the last 10 years, people say, the past model didn't work, we should all supporting an entrepreneur. I think that the reality or it's case by case, right? There's always, it depends. I think that's my personal view, but dominantly, I think the trend is moving towards supporting the entrepreneur and help the original founder to be a successful founder, the Steve Jobs, all that. From my personal experience in investing in over 150 companies, we are kind of extremely lucky. We have 4 companies hitting unicorn status. And then and also some companies I spend a lot of time. I think there's no direct correlation between the time you spend in versus the return. So we always make ourselves available to help on all fronts, recruiting, including, and also help introduce early data investors, as we are seed investors. So a lot of work is to help bridging the next round investors. That's important work. Sometimes we sit on the board, but the key is to the entrepreneur. They have to listen. They have their own ideas. If they every 100% listen to you, that's not a good sign. but it has its own. But if the person does not listen at all, okay, so then you cannot force. So I think it's all over the place. Entrepreneur. The best case is you find the right seed. They know it all. They once a while they ask you a few questions. You provide your input, and they take it or not take it. They say, "Oh, that's actually exactly what I don't want to do."
Okay.
Something like that. Okay.
Yeah, so this is a really interesting topic, and I think the short answer is it's all about the people. And if you take a fund's money, the company is not your own anymore. You have ownership by somebody else, and so you have a duty and an obligation to be open, receptive, responsive. You can reject if you want to, but it's a two-way street, and everybody you meet knows something you don't know. And they've had some experiences you haven't had. And so maybe you can share some of your insights with your investors or board members and bring them up, but it really goes both ways. And being an entrepreneur means you don't know. You've got a hypothesis, you're out there trying to figure it out and test it with investors, with customers. And so if you're not open, you're going to miss the big opportunity.
So I think I can answer this also from entrepreneur's perspective. So when you look for instance, like a funding and also partners that you want to sit in your board for the next couple of years, there are some rules you want to follow. The rule number 1 is you want to always go with the highest tier of VC as you can, but just keep in mind do not go overboard. So after this capital, the most very valuable asset for this VC is their credibility. So a really renowned institute with a deep pocket can really back your company and help your company to grow. But do not also overanalyzing that, since the ranking of all this VC also change all the time because of the good and also bad exit years. So the second rule is partner is very important. You want to look for the right partners who, for instance, want to, if they invest you, it's not because you're the hard deal, but it's because they are a truly believer of what you do. Just remember, they're gonna sit in your board of the company for years and give you really important advice about how to grow your company and how to expand your company. So you really want to work with them. So another rule is you want to choose a partner that is like a soft opinion advisor or investor. So you want to get their advice, but you don't really want to be pushed by them. Like you have to go with our way. So you wanted them to also respect your decision while giving you the advice. So just like the take-home message is when you do like looking for let's say the VC, when you have this like a luxury to choose, and you want to first do the reference check with them, just like how they do the reference check with you. So picking up the right partner will be where this investor is really important and can make your personal journey much more smoother.
These are all great answers. I just want to point out some complexity. There's definitely no good answer because you're not going to be dealing with one VC investor. On your board, if your company keeps growing, you will have different VC investors coming in when the company is still private or even when the company is public. Then each different class of shares have fundamentally some different rights and their demands. So there is going to be conflict of interest between them. So I will be fighting for my class. You will be fighting for your class. Just a most recent example, when Eero got acquired by Amazon. You guys all saw the news 3 weeks ago. Most of the investors didn't make money, only the founders make money, employees didn't make money either. So when the company is called quote unquote successful, it doesn't mean everyone is a winner. Yeah, think about that. And find the guys like these people that are sitting on the panel that are mature enough to be willing to work with the entrepreneur and also work with each other. I think that's very important. Yeah. I would like to switch the topic over to the next question because our dear friend Eugene keeps on saying that he has 4 unicorns, right? Yeah. Yeah. So let's talk a little bit about unicorn. I was doing some research recently. Currently, there are about a little bit over 300 unicorns in the world. On average, each company raised about $800-something million to become a unicorn. 800! Yeah. And of the 300-something unicorns, about half of those are born and raised here in the United States. But if you want to look for capital efficiency, like Eugene is, look at the companies that have raised less than $100 million that still became unicorn or is a unicorn today. There are only 16 of them out of the 300-something universe. And of the 16 unicorns that have raised less than $100 million, 6 are in China, 3 are here in the US, 2 in South Korea, the rest are in Israel, Australia, Philippines, and Indonesia, which means US doesn't seem to be so capital efficient anymore, right? So I would like to take on the panelists' wisdom as to should entrepreneurs today still think about creating unicorns, or are VCs still chasing unicorns? I know you have another topic you're interested, so we'll skip you. And if you want to take the mic, yeah, maybe we have 3 of the panelists answering the question, I think. And Eugene, by default, you have to answer it.
I think we're into an interesting time where maybe we'll have unicorn burgers eventually.
That's it? Okay. So,
Well, that like meat company is about to go public, right?
Yeah, Beyond Meat,
yeah.
yeah.
So
I think, Peter, you are very good at data insights. But as an investor, I think, yeah, we definitely, although early days we call ourselves a super angel, now, whatever, micro VC, but we definitely still looking for potential, very big potentials. You are on a very good point that capital efficiency, like a company, it's not our portfolio. I don't want to promote, only our company, but call it Flexport. They are only very young company. I met the founder, regret we didn't put in money. But after 4 years, yeah, they raised $1 billion from SoftBank Vision Fund. So that tells things are very different. I think in the valley, we are a small fund, so not much impacted. But a bigger $1 billion fund, definitely the game is very different. I think the quickest summary I think is the A, B, C, D rounds. Usually you wait for milestone to put the B round, looking for next milestone, put a B round. But if you really believe that is the company already have enough, that would be a huge hit. Then you want to say, I want to put in
When you say you mean an investor, right?
It is investor, yeah, so putting in right now. I think I can understand that, for a company like, I don't want to promote, but yeah, it's once you read it, you definitely, if I I have $1 billion 3 months ago, I would put in the same amount of money. Clearly, one VC pulled the trigger, did the same thing. So that's kind of I think that, yeah, you earlier mentioned changes. It's clearly, I think it's really,
Eugene, you give me $800 million, I'll create a unicorn for you. In 3 years, just by doing CD in the bank or buying mutual fund. Just kidding.
But you will definitely get scared, right? So if you put money in one company, so if they have a conviction, definitely that's the game right now. So you're putting a lot of, starting with $100 million.
Okay, let's hear a foundation story because you guys definitely have a lot of them under your belt.
Yeah, so the title of the panel is VC Evolution, and so
Yes.
when I think about sort of, if I go back to what we were trying to chronicle with Something Venture, what we were really doing was capturing what I would call the dreamers. Like, these were people that were originating new markets, semiconductors, lasers, biotechnology, video games, right? The market size of those markets was zero at the time the investments occurred because they didn't exist. And so what I wrote a piece for Huffington Post a few years ago called The Disruptors, right? So moving from dreamers to disruptors. And really, to me, that's as good an explanation as I can give you for what's changed in the venture industry and really private equity industry, which is that before we had people that were creating these new markets, like Reed Hastings working on pure software, right? Trying to fix software quality. That was our big thing. And we got the company to $2-3 billion in market cap, so it was pretty good. But then he decided he wanted to blow up one of the $1 trillion industries in the world, the media industry. And so, we were fortunate. We owned 11.1% of the company at one point, so that was great. Led the Series B. That was my partner, Mike Hsieh. But when I look at what it takes to be a disruptor, number one, they're going after very large markets, right? Like the transportation market, the hospitality market, the energy market, right? Very large markets. Number two, they're going after markets.
You're referring to a growing market or an existing market?
Existing market.
Existing.
Large existing market. Number two, they're going after large entrenched competitors in the existing market. So when you combine those two things, you realize that that's what it takes. I mean, if you want to become the dominant transportation company in the world, then it takes the billions of dollars that Uber's raised. If you want to dominate, become sort of the Uber for shipping, you need to do what Flexport did, go from essentially zero to 1.2 billion in the bank over a 3.5-year period, because the market's large enough to support it, but they also have very large entrenched competitors. And that's different. That's the difference between the venture industry 30 years ago and the venture industry today.
Wow, good stuff, huh? Yeah.
Yummy.
So we're blessed to put $24 million in what we feel is going to be a unicorn next, probably 2 weeks from now. And I can talk like this because it's publicly traded. We bought a shell, and I rang the bell on this company 3 months ago. And pretty cool stuff, because getting back to 800 million, we don't need to put it. But we've gone all the way to exit, and we continue buying, but it's public now. Well, we bought again, a lot of us. And so I looked at it a moment ago, it's SVRA, market cap today is 388 million. And so everybody in the room, it's public, so I can say these things, but I think it's going to be a unicorn. And we only put 24 million in this. And that's going to happen in June. So if I'm wrong, you can get your money out, but it could go to zero too. So that's the game we're in. But that's going to be pretty exciting to see that type of leverage you get to be a unicorn. And that's only about 3 or 4 weeks away.
But would you guys, 3 panelists over there, when you invest, do you want the company to have a chance to be a unicorn, or you think as long as I get my 5 or 10x back, that's okay?
Well, I have the mic and I'll pass it down, but we don't care about unicorns personally, because what we care deeply about, and one of the reasons I'm here is because it's strategics. I want to meet strategics all the time. I'll be in Korea next couple weeks from now as a guest at Samsung LG, and we're interested in obviously introducing our companies, and we usually exit before 100 million. And then they go from there to liquidity, or they have liquidity then, and or they go and we get public stock. In fact, I'm chairman of the advisory board of Heritage Bank, which is local. We have 13 locations. Well, they bought my bank, and I don't sell. And I'm stupid, because I love wherever I invest in. And I have now 210 investments, both in my funds and also personally. And I'm not a seller. I mean, you are very broad, I mean, Foundation Capital, I mean, they know when to exit. And so if you're an investor, they know, and I don't. I just love my company, so I just keep investing and let it go, because really I'm
But I believe selling is more important than buying, right?
Yeah, exactly. But I'm working for my grandchildren, which I don't have any yet. I'm working for my children. And I just love the ecosystem of the entrepreneurial spirit. And I will continue investing until I die, because I just love, my perfect day is learning, and you guys teach me a lot.
Great, thank you. I will have, judging the time, I think we have a very, very experienced panel. But I'm going to have two more questions. The first question is to the angle about unicorn, because this is not a term that's invented 20, 30 years ago, right, when Foundation was founded. The other question I have to the fellow panelists is, if you look at a recent study, last year, companies that went IPO in the United States, 83% of them had negative EPS. 83%. And when did we last see statistics of percentage as high as this? It was in year 99 and 2000. And also we have a bio investor here. A significant chunk of the bio companies that went IPO, of course bio have a lot of exit route, including being bought. A significant chunk of the company that are in the bio space that went IPO are negative EPS, higher than 83%. So as entrepreneurs who are developing their business plan, to pitch to the entrepreneurs, if you're in a tech sector or in a bio sector, do you pitch technology? Do you pitch growth? Do you pitch fundraising capability, so on and so forth? And I would like to hear the wisdom from the fellow panelists.
So I think regarding what to talk about, I think I can talk about this from two different angles. First one is generally speaking, yes, like in 2018, we have like 83% of the company going IPO does not make any profitability. And so, which is like reached to a record high compared to years before. So the first explanation is for those type of company, they could choose to make profit if they are focusing on the short-term profitability. However, their investor also want them to instead focus on the long-term growth by spending more on recruiting, on hiring, and also on the research. So the second very interesting explanation actually is coming from the biotech company going public, the percentage of the public biotech company going public. So they are very interesting. A lot of biotech company at this stage, they do not have any product yet. Also, they do not, let alone like already can make a profitability. So many of them choose to go IPO to do the fundraising because of the expensive clinical trial. So one example for the Hong Kong exchange, they allow biotech company going IPO without any revenue generation as long as their market valuation is more than $191 million. And if you look at some data, it would show actually 1/4 of them do not generate any revenue at all. So in the sector of biotech is really a game of like a gambling game. However, the successful cases also pay off very well. So if you are able to, let's say, raise more than $20 million during your initial offering, then 30% of them were later acquired or bought out by big pharmaceutical companies. So that is really a very unique case for that. But of course, for the company that can make profitability along the way will definitely also give them like a less worry when really some, for instance, a recession comes.
It's important to know when to leave the casino, I think.
Cash out, right?
Yeah.
Or cash in.
And I also, so I think if there's some basic principles about your business is, it's got to be a big problem or it's not worth it. it's got to be the right time to solve it. If you're too early, it's just as bad as being too late. And I think you need to have some reason about why now is the right time to do this. Some market structure, some regulatory structure, some discovery, something that makes sense. And then you got to have the right team, and you need to show how you're going to make money. Maybe you're not profitable now, but it's got to be very clear where that's coming. You can't just kind of hope. It's got to be really, just as hardcore certain that it's going to work, or you're just gambling.
Okay, so a quick word. I think, yeah, a good point. I think long term, eventually, you must generate a profit. It just maybe different company have a different story. They can.
Long term is how long?
Okay, so after IPO,
3 years,
3
10
years,
years?
yeah, in 3 years. But if you have a very good story, the CEO is so kind of with the leadership or glory of that, and maybe many investors will help you to stay longer. But eventually, it must generate profit. Period. So, but for a period of time, like now, it's really high. So the public market, will help Lyft and Uber for a while. But it's really, hard to tell 3 years from now if this type of company can, be very welcome on the Wall Street. So, so we investors, we must believe in long-term, business.
Okay. Sorry. The curve looks like this. I'll use it from their perspective. The non-profitability goes like this, up and down. Year 99, 2000 went up to 80-something%. Boom, after that, dropped down to about 40%. Hovered around 40% till year 2009. And then started when QE started, went up to 83% now. Like a straight line. So I just want to put that into perspective. Yeah.
So you telling it's a bubble time? It's already.
I'm not saying anything because, to be honest, there's another phenomenon which I did not share. Unicorns these days actually is not created in 3 years. A lot of those companies that is more than 10 years. It took a long time, but the fundraising capability seems to be very important. Yeah. Go ahead. Yeah.
So I will respectfully disagree with my panelists.
Absolutely.
So I would say there's kind of two buckets of companies. So one bucket of companies that just work really, really hard, find a way to get public, get to sort of between 500 million and 5 billion in market cap. 80 or 90% of those companies are going to get acquired by the companies that have market caps of 50 billion to 100 billion to 150 billion. They're basically just feeder companies that have become new divisions in these large companies. And so whether they're profitable at that point or not is actually kind of generally irrelevant. And the large companies don't care particularly either. They care about the innovation and the potential around it. Witness the acquisition of VMware and other companies like that were sort of, and maybe over and over again in their case. Second part is that if you're a company that has a large enough market opportunity, and I'll go back to Netflix on this, but I remember when Netflix went public, they went public in 2003. Okay, so that was the bottom of that, the bottom of the bottom. So does anybody remember how many companies, tech companies, went public in 2003? Want to take a guess?
10?
Less than 10. Yeah, six companies went public. Netflix's market cap, 350 million. 4 months later, Netflix's market cap, 180 million. Right, because all the competitors came out and were trying to take them down. So you could have bought 10% of Netflix for $18 million back then. That would have been a pretty good investment. But when I think about what we went through quarter after quarter after quarter on the conference calls, it was, when are you going to be profitable? When are you going to be profitable? When are you going to be profitable? When are you going to show more profit or any profit?
That was the instruction from you guys to them?
Not at all. No, that was what the public market analysts were doing because that was conventional wisdom. And Reed's point was, you don't understand how large a market I'm going after. And that's really what you're going to hear from the Flexports and the Ubers and the other people today to say, look, you don't understand. We are the disruptors that are going after the 1- and 2-digit SIC codes. We intend to be the largest companies in the world. And for that to happen, we're going to consume cash for a long time while we build that book of business. And you either have to buy into that or you don't. And I'm not saying you should, but you have to buy into it or you don't. From the other perspective, my colleague here made the smartest comment I think of the day, which is that you got to know when to leave the casino. And it's very, very difficult to look at your institutional holdings and your personal holdings and say, it's time. I've had enough. I'd rather be on the sidelines for a while. I have friends that did this 2 years ago, 3 years ago. They said, that's it. It's topped. They got out of the market 2 or 3 years ago, so they left 50% on the market in that time period. So, you know, if you career, I would have magically sold everything I had the day before the downturn, but it just doesn't work that way. So you have to kind of figure out your own approach to these things, both institutionally and personally.
But Paul, let me, since you disagree with the panelists, maybe to me, I don't know, I think we can still be good friends. When Ella was saying her first topic that one wants to find a VC who's first here and also has deep pocket, is that associated with this theme that you have about profitability, also with Unicorn? You want someone who can be with you for the long term and can put tens or hundreds of $1 million into you, or you think different VCs have different roles?
I think different VCs have different roles.
Yeah.
You know, we work with very, very high quality entrepreneurs in the past and the present, and they choose to work with us. You know, we have a few areas that we're very deep. We're very deep in fintech, we're deep in AI and ML, we're deep in consumer marketplaces. So we do very, very well with repeat entrepreneurs and getting people back there. We're a $350 million fund, right? So we're not,
it's not big.
You know, we're not a money warehouse. And so they're coming to us because 70% of the time when we put money in, we're the first money in. That's been consistent since 1995. And they come to us because they want early stage help in forming the company and building the teams and so forth. They're not coming to us because we can write a check for $30 million at a valuation 10% more than the person down the street, which is a perfectly great skill, and I think in some ways that's an easier way to make money, at least when the market's going up. I will make a parenthetical comment. When you look at our funds or anybody else's funds, the worst funds are the ones where you basically decide it's time to go late, it's time to put money into late stage projects, and you start pouring into late stage projects, and then the market goes down. You might as well just literally just close the book and burn it. It's just nothing good is going to come out of that.
Yeah, VCs can get rich because of management fee in that case.
Yeah, but that's a different argument, a different set of topics around it. If you want to be good at anything in terms of your job, you want to be good at it, and so you don't want to be the one that's pouring money into late just before the market goes down. That's musical chairs.
Yeah. Randy, do you have any wisdom you want to share?
Well,
oh, sorry.
Peter, can you rephrase the question?
Oh, you want it in Chinese again? Let me look at my notes here.
I was enjoying it. Obviously, my colleagues, these are some great wisdom.
This is related to profitability at IPO. Do you invest for profitability?
Absolutely.
Absolutely, yes or no?
Absolutely. I'm focused on execution, and the execution yields obviously in customers, and customer yields obviously equates into capital. I watch all the time. I'd be a stupid investor right now with some of these, you know, Ubers of the world, because I just, you know, my DNA is execution and profitability, and we're blessed, and my business has been
sorry, I
day one.
disagree. I don't think execution and profitability sometimes go hand in hand.
No,
right?
that's correct. But my vision, execution is money.
Oh, okay.
And actually going to a customer and saying, if you believe in this, let's say, you know, they have an enterprise salesperson, he like my son's with Expanse, he just left Cisco, and he's selling cybersecurity. And if he can't convince a client to pay for it, then, and you know, I don't think that's, you have to be worthy, and I love that customer validation by capital.
Let me try to not get myself confused and put a qualifier on what you just said. You invest for execution and profitability at IPO or post-IPO, because otherwise you're going to miss 83% of the IPO.
No, definitely post. And again, our you know, we've had 18 failures. We've had 123 liquidity events, and liquidity events are all under 100 million because they're being bought by strategics. I call them strategics, but you know, then they get absorbed, and so, but they have executed. let me tell you where I've lost money as an investor. Before I started Keiretsu Forum, I remember walking into a room where we underwrote them for about $4 million, and there was 26 engineers there. I said, where's the sales and marketing? Where are the people actually selling? And they didn't have any, because that's not their DNA. So you gotta make sure the CEO has the ability to hire sales and marketing people, which I love, because sales and marketing is what moves the needle in regards to an exit.
Okay, so very quickly, I want to just share something I personally just learned, in the last 2 weeks, within the last 2 weeks, about profitability and a SaaS company, right? So we all know SaaS company, if you have very low churn rate, right, the revenue is very high quality. That means, 100 people pay you, they will, if they are happy, they will continue to pay you, and then you only acquire new customer and adding onto it. So that's why the Wall Street, we have to kind of learn to accept how Wall Street, they are evolving, but how to evaluate the company. So now a SaaS company is valued very high, because the SaaS company, once they meet a certain matrix, and then the Wall Street will reward you with very high rich multiples. But typically SaaS company become a profit very late. You look at all the Zscaler or Elastic, all the companies in SaaS, they achieve profitability very late. But even though, as long as you have the high growth rate, the Wall Street still give you maybe 15, 20x, that kind of number. But what I just learned recently was this phenomena. If you are really, really much better than this, if you are creating profit, even you are a SaaS company at a high growth, you will get rewarded much, much better. This is the Zoom case. I read all the article. What I missed, I think this is crazy. What is the thing that some people write an article about? Because compared with all the other SaaS companies, this company called Zoom, they have 100% growth rate versus other company, when they go public, is below 50. And then that's the growth rate. And then
Eugene, the 1 minute is up.
So that's also I'm saying is that if you create this compatibility, you will reward it much better. That's what I'm saying.
Thank you.
I just wanted to say also, Zoom really works. It's a good product, so that's why you get that. So I think
it sells itself.
Yeah, this is a big impedance matching problem. You need to match your VC. Maybe some VCs want to do build to sell, but maybe you don't. Maybe some VCs can tolerate low profitability or no profitability for a long time. You need to be in the same sync with your customer and with your investor.
Okay, I think we only have 3 minutes left. If I can overrun for like 2-3 minutes, I'd appreciate that. Whoever is doing the timing here.
Just do it.
Let's just do it, right? Okay, we're bad guys. We're vulture capitalists, right? Or some. Anyway, the last question, of course, unavoidably, I have to ask about China. Yeah. We have entrepreneurs and also representatives from China. We have VCs who came from China. And with the tension, do you still want to aggressively have a China strategy? If so, what might that be? I'm putting it at as high a level as that. Oh.
Yeah, quickly, I do. We've been in China for 10 years, but sadly we lost our president. And so we're looking for leadership, and the job description of that leadership is someone who can build and retain a community of investors that care deeply about entrepreneurs. And we have 3,600 members around the world, and we're remiss not being in China. We circle it. We're in Singapore, we're in South Korea, we're in 4 locations in India, but we definitely want to come back to
So we've never had a presence on the ground in China. It just hasn't been part of our strategy. We're Silicon Valley based, and we're pretty small from that perspective. We do have Chinese limited partners. They've been terrific. I typically go over like once a year and give a talk at the entrepreneur conferences, where it might happen to be. China's going to be one of, if not the biggest growth engine for the global economy over the next 50 years or so. So I think it's impossible to ignore from that
So
perspective.
you would still encourage your portfolios to...
Oh yeah, absolutely.
Yeah.
So, really quickly. Yeah, I think our strategy is treated as 2 markets. Don't mix them. That's how we, yeah.
I think there's a big opportunity to take companies with proven IP or trade secrets in a mid-size and do distributions with true Chinese companies where they have some exclusivity to that market and you're protected through agreements so the incentives are right and the people are right. And that's the big opportunity till things change there.
Or here.
Yeah, yeah.
Yeah, yes, since like mid 2017, there are more and more tension between U.S. and China regarding like the patent issue, the trade issue. However, when you like talking about from international trade, the whole globe is actually on one stage. And actually also when you're looking at this, all this transaction number of the cross-border deal happening in 2018, actually the number hit also record high compared to years before. And there's also a number talking about this deal going on. But one thing I think I worth to mention is when you look at the number. So when you look at the the cross-border activity happening in 2018, 63% of them actually are happening from the US-based investor and the China-based company, which is a perfect reverse of what happened in 2016, when 63% of the cross-border activity happening between Chinese investor, China-based investor and a US-based company. So this is also something like worth people also to think about it. So my opinion is like in some way, the VC investor from both of US and also China, they sort of like still put aside this political issue because they're still seeing the money making as the absolute goal. And also, in my view, this all this like tension like between China and the US, they are eventually they will also ease off, and then we just like need to have a better prepare for it.
Okay, that's great. I'm going to steal one more minute, and that minute I'll give it to you, Eugene. You can pick one audience for one question. Yeah. Don't state your comments, but please, if you have a question, raise your hand. You did that first. Yeah, please.
Thank you. My question goes to the Keiretsu folks. So you keep the company of such gentlemen and ladies who have raised unicorns, have so much money. So why is it that you guys charge entrepreneurs for coming to pitch to these guys? And it's like hefty fees of 3 to 5K. Most of startups, especially in social impact.
No, we got your question.
Yeah, the question is
because we have 364 members in the Bay Area. We have staff of 7, and our members want later stage. And it's a great litmus test. We have a lot of wonderful dreamers out there, but they're not yet ready for us. And so we are only bringing in 50 companies a month come to us, and we only choose 4. If we're in this for profit, we'd have 50 companies presenting. The whole spirit of it is we don't take any warrants or commissions, never will. We've never had a lawsuit in 18 years. And so, yes, there is an administrative fee to present, but there's nothing else. And so we're very proud of our model, and we're the largest network in the world of what we do.
This is great. Okay. Am I allowed to have one more question? Let's see, you're saying, am I allowed to have one more question? Or, okay.
Very quickly.
Yeah.
The most recent technology is internet, which is 30 years old. After that was 4 patents I filed in 1990.
Your question.
I keeping submitting my business plan to VCs. VCs said my company is too earlier, and I told VCs have only one choice: invest in me or lose money. 20 years later, VC keep losing money. How long you want to go?
Anyone want to take that?
What's the question?
VC said if we don't invest money, we will not lose money. We will lose an opportunity, but not lose money.
That's
Yeah.
all. That's all over the world. Just
Yeah.
not touch here.
Yeah. Anyone want to take that? No? Thank you. I personally learned a lot from this panel. Thank you guys very much, and thank you. Let's have a group picture of the panelists before the next.